Welcome to this webinar by Melha Nadar and John Bluedorn on the International Monetary Fund's World Economic Outlook Managing Divergent Recoveries. My name is Renee Fry-McGibbon and I'm a professor of economics in the Crawford School of Public Policy in the Centre for Applied Macroeconomic Analysis at the Australian National University. Before we begin, I would like to acknowledge and celebrate the first Australians on whose traditional lands we meet and pay our respects to the elders past and present. Our two speakers today are good friends of Karma. Melha is a frequent presenter in our real life in-person events that we used to host back in the pre-pandemic days. So we're really delighted to be able to see him again. You may also remember John Bluedorn. It's been exactly 1 year ago that he spoke to us through one of these webinars in the depths of the pandemic, in a joint presentation with Ihan Coates from the World Bank and Warwick McKibben from the ANU. So a year later, it's nice to be talking about recovery. So the work that Melha and John will be outlining today comes from the World Economic Outlook, which is the IMF's flagship publication that flags its views summarizing the global economic outlook, and it also explores pertinent issues for the world economy in greater detail. So Melha heads the World Economic Studies Division in the IMF's Research Department, which produces the World Economic Outlook. In previous roles, he has been in the IMF's Asian Pacific Department. He's covered China and Japan and was mission chief for Hong Kong. Melha's research interests are in financial development, investment and productivity growth. And before joining the IMF in 2009, he was an assistant professor at Wellesley College and he holds a PhD from Brown University. John Bluedorn is a Deputy Division Chief on the World Economic Outlook's IMF Research Department. He has been a senior economist in the Research Department's Structural Reforms Unit, a member of the IMF's Euro area team in the European Department, and worked on the World Economic Outlook as an economist. Before joining the IMF, he was a professor at the University of Southampton in the UK after a postdoctoral fellowship at Oxford. John has published in a range of topics in international finance, macroeconomics, and development. He holds a PhD from the University of California at Berkeley. Before I hand over to Melha and John, I would like to let you know that this event is being recorded and will be available on the Karma website in the next few days. And if you'd like to ask a question, so please use the Q&A button on Zoom. And if you'd like to ask the question in person to appear on camera, then please send me a private chat and I'll invite you to ask in person. We love to see you, so please do that if you would like to. So now I will hand over to Melha for his presentation. Thank you, Melha.
Thanks very much, Renee. Thank you for hosting us again in this webinar. It's a pleasure to be with you. I hope we can do this in person before too long. What I'd like to do over the next few minutes is just give you a quick overview of our latest thinking on global economic prospects, drawing from the report that we published recently, Managing Divergent Recoveries, but also giving you a sense from the latest data as to how we see things shaping up after the report was released. In particular, I'd like to do three things. The first is to talk about the forces shaping the recoveries, the type of recoveries that we should expect going forward. Second, to drill a little deeper into what we see as a key theme emerging in this recovery, which is divergences within and across countries. And finally, to talk about the type of policies responsive, the policy priorities that we see both at the multilateral level and at the national level in order to place all economies back on paths of durable recovery. So just to preview these three main parts of the presentation, in terms of the type of recovery that we expect, clearly the key forces shaping this recovery include policy support. That's been a big factor behind the rebound that we saw starting in the middle of last year and continues to be an important force shaping the recovery. Adaptation to remote work has been a key feature of the recovery and has, in fact, to be honest, surprised us repeatedly as to how much activity has been able to adapt to restrictions. And finally, and most importantly, over the last few months, the rollout of vaccines has given us hope that there's a way out of this health crisis and in particular for the advanced economies, which have been able to get their hands on the vaccines and procure adequate doses for their populations, they can look ahead now to further normalization of activity in the remainder of the year. But of course, as we know, vaccine access remains highly unequal, and there are large parts of the world which still have to contend with the possibility of renewed waves of infections and rising death tolls. This is one of the sources behind the divergences that we're seeing, but it's not just across countries, it's also within countries. We've seen manufacturing come back a lot stronger than services, and we've seen different demographic groups affected in different ways. And John will talk a little bit, we'll go into more depth on the labor market aspects and the inequality aspects of this crisis. One thing I'd like to flag in terms of the recovery that we see coming out of this is that looking out over the medium term, we expect these recessions that we've seen countries going through over the past year or so, they're likely to inflict smaller persistent damage on the economy, smaller medium-term losses than what was seen after the 2008-2009 financial crisis. But this depends crucially on two key assumptions. The first is that we are able to actually beat back this pandemic globally by the end of 2022. And second, that there's no systemic financial distress coming out of this. We've been able to avoid that so far, and it's important to keep that under control and prevent this health and economic crisis from morphing into a financial crisis. One interesting pattern that we see over the medium term going forward is that this time around, it's actually the emerging market and developing economies that are expected to suffer larger losses than advanced economies, whereas last time around it was the reverse, because advanced economies were the epicenter of the financial crisis. So in terms of the first key force behind these divergences and the divergent recoveries that we're seeing is, of course, the differential policy support that we've seen across countries. The chart on the left shows you that advanced economies were able to provide significantly larger amounts of fiscal support. This is direct above the line fiscal support that was provided to households and firms as a fraction of their GDP, compared to what the EMs were able to do, and certainly way larger than what the low-income countries were able to do. And this is a reflection of the different policy space that these economies operate with. But it's not just fiscal, it's also monetary, with central banks, particularly those that have cut interest rates all the way down to the effective lower bound. We're also providing a lot of support through unconventional means, through asset purchase programs, which has dwarfed the size of these asset purchase programs, as the chart in the middle shows you, has dwarfed what we're seeing after the global financial crisis. The sum of all of these policies, the effect that this has had on global outcomes has been pretty significant in terms of what we see as the overall impact of the policy support. The chart on the right shows you that our estimates suggest that in the absence of these measures, the global contraction last year would have been close to 10%, negative 10%. But what we actually saw was negative 3.3%. So roughly 3 times worse outcomes would have happened had these policies not been implemented. The second major force behind this divergence is, of course, differential progress in beating back the pandemic. The good news, of course, is that worldwide cases have been coming down recently. A lot of that has to do, of course, with the rollout of vaccines, but here there's been differential progress across countries, with the advanced economies in particular able to vaccinate a much larger share of their populations than the EMs and the LICs have been able to. The good news, of course, is that the evidence suggests that these vaccines are pretty effective in preventing hospitalizations and severe cases of COVID. Israel has been a case that's been watched very closely because of the speed at which they rolled out the vaccines. And as the chart on the right shows you, the groups that were vaccinated first, the vulnerable groups, the elderly, saw infection rates coming down a lot faster than the groups that were vaccinated later in the vaccination drive. So all in all, this is good news going forward, that with access to vaccines, there is a way out of this, and we will be able to bring these infections down, assuming, of course, that we're able to get ahead of some of these worrying new variants that have emerged. Now, in terms of the numbers, I want to just briefly touch upon the forecast that we released in April, but we are in the process of updating these forecasts, and we will have a new forecast in about 4 weeks from now. But back in April, we estimated that the global contraction last year was negative 3.3%. and we projected a rebound to 6% this year in 2021, which is an upgrade relative to the forecast that preceded it. And the upgrade comes mostly because of the countries that are shown on this slide here, the advanced economies. And within the advanced economy group, the United States in particular, where we saw the legislation of the American Rescue Plan, additional fiscal support in the US, that has yielded a 1.3 percentage point upgrade to the growth forecast for 2021 for the United States. Similarly, increases across the board for the other advanced economies, partly reflecting additional policy support, but also improved health metrics and adaptation to remote work. The EMs shown here on this slide, we upgraded their forecast as well to 6.7% for the group as a whole, largely because of the upgrades to China and India at that time. Again, the India forecast was closed at the time when the horrific second wave had just started. So the impact of that second wave is not reflected in this number. And by the time we released the forecast, we were aware that this second wave was going to pose severe downside risk to the forecast. And so this 12.5% number that we've shown for India was from a time before the second wave had really taken off. And as I mentioned, we're in the process of updating and revising these numbers going forward. But all in all, a very sharp rebound this year, snapback from the deep contraction of 2020, and then a moderation in growth next year as the recoveries mature. Now, looking out further into the medium term, as I mentioned, we do expect significant losses from the COVID crisis, but we expect that they won't be as large as they were after the global financial crisis. And the chart on the left shows you the comparison between the two global events. And there are two main takeaways here. The first is if you compare the blue bars, which is the GFC, with the red bars, which is COVID, as you can see, for all of the income groups that we track, except for the low-income country group, the persistent losses that we expect going forward after COVID-19 are much smaller than what was seen after the global financial crisis. And the second takeaway from the chart is that there is, as I mentioned, this reversal of the pattern of losses. In the previous crisis, the blue bars, it's the advanced economies that suffered much larger medium-term losses compared to other groups. This time around with the red bars, COVID, we expect that it's the low-income countries that will suffer larger losses than the advanced economies. Drilling deeper into the regional variation in terms of these medium-term losses, the chart on the right shows you that we expect the biggest losses to occur in the EM Asia, excluding China region. And a large part of this, of course, is India, but it's also because of the large concentration of tourism-dependent economies in the Pacific, which have been severely hit by this crisis. But as the chart shows, the chart on the right shows, it's pretty much across the board for the emerging market regions that we expect very severe losses, whereas for the advanced economies, much smaller losses. And in fact, for the United States, after the legislation of the American Rescue Plan, the projections now suggest that over the medium term, by 2024, the level of GDP will actually be higher than what we had projected before the pandemic. And this is almost entirely a reflection of the massive policy support that's been put in place in response to COVID-19 and the subsequent fiscal support that was legislated this year. Now, as I mentioned, it's not just across countries, but also within countries that we expect to see divergences. And one key legacy of this pandemic is, of course, the losses to human capital accumulation as a result of the school closures that we saw last year. The ability of some economies to substitute away from in-person learning to remote learning was much greater than it was for others. And so the advanced economy group was able to minimize the losses of instructional time by switching into remote learning. But low-income countries were not able to do that, not able to provide as effective a substitute modality of instruction for their students. And as a result, the estimates for the average missed days of instruction in 2020 for low-income developing countries is almost 7 times that of the advanced economies. These are not our numbers; these are UNESCO's numbers, but our internal calculations suggest that these are broadly right in terms of magnitudes. And of course, what this means is, first of all, at the individual level, slower earnings growth going forward unless there are some remedial measures put in place to offset these losses to human capital. And at the aggregate level, of course, it means slower human capital accumulation and slower productivity growth going forward over the medium term and long term. We did see income inequality coming down prior to COVID across the EMs and low-income developing countries compared to before the financial crisis to what we saw right before COVID. Gini coefficients had come down on average across these countries. But now we expect with the COVID crisis and the acute impact that it's had, disproportionately acute impact that it's had on workers with lower educational attainment, on women, on youth, we expect inequality to go up as seen with the gray bar. And the increase in inequality is actually expected to be larger than what we've seen after previous pandemics. So a pretty significant impact across demographic groups and the makings of what people have referred to as a K-shaped recovery, with some groups doing well on the upper arm of the K and others falling away persistently in the lower arm of the K. Now, that's the baseline. And of course, from the start of this pandemic, there's been huge uncertainty around the baseline, how we project the forecast, how we project these numbers. So in terms of the uncertainty and the factors that could lead to different outcomes than what we're seeing, with what we're projecting in the baseline, for now, we think the risks are broadly balanced in the near term. The recovery could, of course, turn out to be stronger if, in fact, cooperation and coordination on vaccine distribution proceeds faster than what we're assuming. And there has been a buildup of excess savings, particularly in advanced economies, that could be drawn down fairly rapidly once economies reopen. And this could lead to more front-loaded spending, an increase in confidence, and overall faster recovery than what we're projecting. But there are significant downside risks, primarily related to the pandemic and primarily focused in the EMs and low-income countries that don't have access to adequate access to vaccines at this point. And the concern here, of course, is that with large susceptible populations, that provides opportunities for the virus to mutate and for the health crisis to be extended in these countries. There's also a worry about how financial conditions will evolve. They've been very supportive so far. We went through a period of volatility in the first quarter of this year after the Georgia election and after as markets began expecting major shifts in US policy stance, especially from the Fed. But things have calmed down since. The 10-year yield has come down, has leveled off and has actually come down a bit. But of course, there are concerns that there could be a reassessment of monetary policy going forward, the outlook for monetary policy, and that could trigger another episode of the kind that we saw earlier in the year. We've seen that bankruptcies have been fairly well contained so far. As support is withdrawn, bankruptcies could come to the fore, and that could lead to an abrupt tightening of financial conditions. I'm going to spend a little bit of time just going a little bit deeper into these two risk factors, the pandemic and financial conditions. But before I do that, I also want to flag that we also worry about weather-related natural disasters, which have increased in intensity and frequency over the past few years. We also worry about cyber attacks on critical infrastructure, rising geopolitical tensions, and the continued uncertainty around the trade front, which with some of the tariffs that were put in place before the pandemic still in place at this point. And of course, that further intensification of those tensions could weigh on the recovery going forward. Now, just to drill a little deeper into two of the risk factors. First, the pandemic. It's this race between the vaccine and these new variants. And the chart on the left shows you the current state of play. There's been about 30% of population in advanced economies have been able to have been administered their full doses, the full courses. But that number is less than half in emerging markets, and it's just a tiny fraction, barely registers in low-income countries at this point. The chart on the right shows you the variation across regions, with US and Canada, of course, able to move very rapidly on vaccinations, but huge variation across other regions. And Sub-Saharan Africa, for instance, just about getting started on its vaccination drive. So this is, the longer this discrepancy persists and low-income countries fail to move forward with their vaccinations, there's greater risk of this pandemic being extended. And of course, that means that even countries that have been successful in vaccinating their populations are still at risk with the virus circulating elsewhere. The second factor that I wanted to briefly touch upon is the prospects of financial conditions. The divergent recoveries that we're projecting, of course, give rise to the prospect of divergent policy stances. There's already been a significant repricing of the expectations of the liftoff of Fed monetary policy. As you could see the chart on the left, for the United States in particular, markets have brought forward their expectations of the Fed liftoff and the path of interest rates, policy rates in the US, compared to what was expected back in October 2020 as captured by the dashed line. This is earlier this year translated into a very steep increase in 10-year government bond yields in the US, and that, as I mentioned, is leveled off recently. Partly also this reflected worries about inflation. It was well anticipated that headline inflation would pick up over the last few months. We talked about this going back a few months now because of mechanical base effects from low commodity prices last year. And that, with the rising commodity prices this year, that would mechanically lift headline inflation. But we've also seen core inflation increase in some cases, particularly in the United States. Our reading of this is that at this point is that these are largely transitory disturbances reflecting supply-demand mismatches coming out of the pandemic, and that once these issues are resolved, inflation should subside again to the pre-pandemic range. So all in all, yes, we expect inflation to be temporarily high this year, but we expect it to subside going forward. And most importantly, at this point, at least, we still see inflation expectations well anchored. And of course, clear central bank communications on their interpretation of the drivers of inflation and the outlook for monetary policy is going to be key to shaping those expectations going forward. As I mentioned, extraordinary support, credit guarantees, moratoria, and debt repayment, and policies of that nature have managed to keep bankruptcies in check. This chart here shows you that compared to the line in blue is the Great Lockdown. Compared to prior to the pandemic, we've actually seen bankruptcies come down relative to 2019. And that's very different from what we've seen in previous episodes, certainly very, very different from what we've seen in the GFC. The concern, of course, is that going forward, as the support is withdrawn, some of these bankruptcies could come to the fore, and that could abruptly tighten financial conditions. So just very briefly, what are we seeing after this forecast was released? What are the key considerations for the outlook? First, on balance, first quarter GDP surprised on the upside with most regions, most countries that we track here, the bars in green showing you the positive surprises. This was largely in East Asia, excluding Japan and China, and also in Latin America. The negative surprises were mostly in Western Europe because of renewed restrictions, renewed lockdowns that were put in place when the second and third waves picked up there. But overall, GDP surprises have been to the upside, and that, of course, puts us in a better starting position for this year and for the growth forecast for 2021. The manufacturing rebound has continued and has now begun to spread somewhat to services as well, especially in places where infection rates have come down. And this has been accompanied by a widening trade recovery, even with the near-term disruptions in certain sectors. We've seen trade strengthening, and the category of goods across which this recovery has taken place has expanded beyond the initial group, which was mostly consumer durables, medical equipment, pandemic-related equipment. Now it's a much broader category of goods over which we're seeing this trade recovery, and that's, of course, a good sign. It's a reflection of this manufacturing rebound that we've seen. I'm sorry, I don't know. The screen seems to have gone blank at my end. I don't know if you can see something there.
Blank here as well.
Oh.
Maybe try. Yeah, we can see something now.
Yeah, this was the slide that I had. I'm just gonna. Yeah, I'm not sure what's going on, but I see that I'm running out of time in any case. So maybe I could just wrap up. I'm sorry, I had a couple of more slides, but somehow my slideshow is just stalled here. There are a couple of things that I wanted to say beyond this point were that the first, of course, is that with the data that we're seeing, the data have suggested a stronger starting point for the forecast for this year, which which is good news, of course, but we do worry very much about the situation, particularly in places like India and Southeast Asia, where there have been renewed waves. India has now been able to get the second wave under control, but there are still worries that with the low vaccination rates and large segments of the population still susceptible to infection, that the countries many countries haven't turned the corner on the pandemic, and that's a big worry going forward. Finally, just to wrap up with a quick word on policies. On the multilateral front, of course, the overarching priority, no surprise based on what I've been saying so far, is to ensure that there's equitable access worldwide to vaccines, and a big role here, of course, in terms of advanced economies have a big role to play here in terms of donating surplus doses to emerging market and low-income countries to ensure that those countries have more rapid access to vaccines. There's been good news in terms of additional funding for COVAX, the collective procurement vehicle for vaccines, just recently, where the global community has come together to provide has committed additional funding to COVAX to enable the COVAX vehicle to provide vaccines to 30% of the population in the 91 AMC countries that they're targeting. So that's of course good news. And there was good news coming out of the G7 summit with the 870 million doses that were donated, the commitment to donate 870 million doses. But this is just the start, and more needs to be done to ensure that vaccines are distributed as rapidly as possible to low-income countries and to certain emerging market economies, to ensure that they're able to look forward to a full normalization, just as the advanced economies are at this point. The second area that we in the IMF are particularly focused on, of course, is ensuring unimpeded access to international liquidity for financially constrained economies. And we've proposed, as you know, a general allocation of SDRs, the special drawing rights, which once it's approved, it's still in discussion, but once it's approved, it would actually boost global reserve assets, and in particular ease the external constraints on some of the low-income economies, and allow them to manage the trade-offs that they're facing in a better way than they're able to at this point. So I'm sorry about the tech glitch at my end, but perhaps at this point, on that note, with those two priorities that I just mentioned at the multilateral front, I could maybe turn it over to John, who's going to take us into the labor market implications of this crisis.
Thanks so much, Malhar. Let me share my screen. Okay, hopefully you can see everything okay. So yeah, so thanks much for the opportunity to present some findings. So Malhar presented the outlook, and then in the context of the WEO, we also have some kind of more in-depth kind of thematic looks at a few topics. And in this case, it's going to be on the labor market and kind of what's happened around COVID, and kind of what are the responses and policies that how they can help kind of manage the effects, in particular on employment and differences in the effects of across worker groups of the pandemic shock. So this is a product of joint work with a really great team of colleagues at the IMF listed here. So let me start by providing this broad overview of labor market dynamics that occurred in 2020, really the kind of the year of the pandemic in both advanced and emerging market and developing economies. So as we know, the COVID-19 pandemic shock has been causing large economic disruptions and worker dislocations around the world. Unemployment rates were up in 2020 compared to 2018-19, their averages there, in both advanced economies and emerging market and developing economies, and that's what's shown here. Those unemployment rates are up by roughly 1 percentage point on average in both these groups of economies. when focusing on labor force participation, we can see that the emerging market and developing economies have seen a sharp drop on average of about 3 percentage points. This is larger than what's seen in the average advanced economy. They've also seen a drop in participation, but much smaller at about 0.4% in 2020. These overall changes, though, mask some important differences that we've seen in the labor market impacts across worker groups. And in particular, the lower skilled, those with secondary education and below, and youth have been hit harder in the average advanced and emerging market and developing economy, with notably larger rises in unemployment rates than those seen for higher skilled and prime age workers. These groups also tend to have higher unemployment rates on average in normal times, highlighting their more fragile labor market conditions. Now, moreover, in emerging market and developing economies, women have seen a greater rise in unemployment on average for the year, while there have been some signs that marginally men in advanced economies have been harder hit than women on average. If you actually kind of really unpack what happened in 2020, you see that there is a time pattern where actually in 2020 Q2, there's a little bit of reversal of that, and actually women were really hit much harder than men on average. We actually have some other work on that in an IMF working paper, and it was also published in COVID Economics. So part of the story behind the differences in labor market impacts across worker groups is the asymmetric effects on sectoral employment of the COVID-19 shock. So this reflects in particular the larger direct impact of the pandemic on more contact-intensive work and sectors. So in particular, as we see in the left-hand charts, there were large declines in employment in the sectors related to wholesale and retail trade, transportation, and accommodation and food service. That's indicated by the trade/ACC bar there. This is it, as well as arts and entertainment. That's the arts/serve bar there. This is in contrast to what we observed on average during previous recessions, that's in the right panel, where manufacturing and construction in particular were typically hardest hit. That said, it's also important to note that the broad sectoral pattern seen with the pandemic recession is similar to that observed in past recessions, namely that sectors that have tended to shrink are those that are more vulnerable to automation, and they're shown by the red bar shading as opposed to the blue. I can discuss more about kind of the details on how we define the vulnerability to automation if there's questions. Otherwise, this has gone into more detail in the report. But unpacking this last point, we can see that the trend over the past 30 years has been for employment to shift away from sectors that are more vulnerable to automation. And that's coincident actually with the share of employed workers with lower skills in total employment that has also been falling. The shift reflects in part direct movement of employed workers from more vulnerable to less vulnerable sectors, as shown in the two right-hand charts in the green shaded component of the bar there. However, more often it comes from the net hiring of workers from unemployment and non-participation. That's the yellow and red shaded components of the bars. Since reallocation in this way tends to work through joblessness, the social costs can be high. This is especially true during recessions when sectors that are more vulnerable to automation see large outflows into unemployment, as shown in the middle chart. To summarize, what we've seen with the COVID-19 pandemic shock is that it has been highly asymmetric in its employment impacts across sectors and demographic groups, with potential implications for inequality and labor reallocation. So in the next set of slides, I'm going to show some analysis that we did using historical data on labor market transitions at the individual level across the business cycle to assess kind of how the current shock may differ from the past or be similar, and based on that, what we might expect. So here, as seen in the left-hand chart, the overall probabilities of job finding, job separation, and sectoral switches, meaning changes in the sector that you're employed, at the individual level differ across phases of the business cycle. The probability of finding a job is about 30% on average in our sample, and this is a mix. It's largely advanced economies, but a mix of some advanced and emerging market economies. So that probability is 30% in our sample. Comparatively, separation and sectoral switches, the probabilities of those two are about 3%. These are roughly consistent with what we see in the broader literature on labor market kind of transitions. We also see that job finding tends to be lower in recessions and recoveries than in expansions. Conversely, separations are higher in recessions than in expansions and recoveries. Sectoral switches, meaning on the job, tend to be pro-cyclical, as found in the literature. In the middle chart, then, we aim to assess the inequalities that exist between demographic groups, and in particular age, gender, and skill for those outcomes. And what you see there is we observe that on average, finding a job tends to be easier for the young, but more difficult for women and those that are low skilled. For sectoral switches, we observe that the young tend to be more advantaged. Actually, they find it easier to switch employment, sectors of employment. However, if we focus on past recession periods, as seen in the rightmost chart, the picture changes a bit. During recessions, the young are particularly disadvantaged in finding a job, while women actually tend to be less likely to be laid off. And that's a little different than what we saw earlier in the COVID-19 pandemic recession. The lower skilled tend to instead have both a higher likelihood of finding a job and also of losing it, but it ends up that this separation effect dominates, leading to higher unemployment in downturns for this group on average. So taken together, these findings suggest that past recessions showed many similarities to the current crisis, with youth and the lower skilled particularly disadvantaged in the labor market. In addition to switching the sectors where people work, labor reallocation can also occur through workers changing occupations or the types of jobs that they do. This dimension has become particularly relevant with the COVID-19 shock, given that there's this premium placed on occupations that allow for remote work. However, occupational switches by workers don't occur in a vacuum. They are strongly related to the worker's employment history. The left-hand side chart here shows that occupational switches are much more likely for an unemployed person that gets reemployed than for a person that switches jobs while remaining employed. We call this an on-the-job switch. The likelihood that someone switches occupations upon reemployment after an unemployment spell is about 45%, so meaning almost half. While for someone staying employed and simply choosing to switch jobs, it's closer to about 10%. So this suggests that workers tend to prefer remaining in their current occupation unless circumstances, such as a prolonged spell of unemployment, force them to switch. The right-hand chart here suggests a potential reason for this. While on-the-job reallocation to a new occupation is associated with a modest earnings gain of about 2%, an occupational switch after an unemployment spell is associated with a large earnings drop of about 15% on average. So it's costly. So in the chapter, we also see that these occupational switches and the earnings changes, we don't see big differences across the business cycle. However, among lower skilled workers who are able to find reemployment, the likelihood of switching occupations via unemployment increases during a recession. So this is particularly concerning in light of the COVID-19 pandemic recession, given that it suggests that the lower skilled are being hit with a triple whammy. So what is this triple whammy? Well, first, they're more likely to be employed in sectors that are disproportionately impacted by the pandemic, in particular, more contact-intensive, lower skilled services. Second, they are more likely to become unemployed in downturns. And third, among those who find a new job, they are also more likely to have to switch occupations and suffer an associated earnings penalty. So far we've established that recessions typically prompt reallocation, and that reallocation can be costly, impacting some worker groups more than others. The question is then what policies can do to help mitigate these costs and ease the labor market adjustment in the context of the COVID shock. So to answer this question, we use a newly developed search and matching model of the labor market where workers differ in their productivities for different kinds of work. In particular, the model has different occupations with different degrees of contact intensity and skill requirements. And this is going to translate into different levels of exposure to an adverse shock. So we consider in particular the effects of a pandemic or lockdown shock that causes social distancing to increase. This hurts the contact intensive occupation and hence lower skilled workers disproportionately. The shock is modeled as being largely transitory, lasting about 4 quarters, but part of the impact on occupational employment persists, leading to the share of contact intensive occupations to permanently shrink. So what you see in the chart here is the results from the model simulation. The blue line shows the effect of the shock on unemployment in a scenario where there's no policy support. As you can see, there's really an enormous increase in the unemployment rate from the shock, and then it takes quite a while to unwind. But then we analyzed how this shock could be mitigated through a mix of retention and reallocation support measures. In the model, job retention support takes the form of government transfers that cover part of firms' wage bills when worker matches are temporarily no longer profitable. So this is something like a wage subsidy. Reallocation support is given as government subsidies to firms that reduce the cost of them creating new jobs. So it's like a hiring incentive. So what you see in the red line is a policy package that has job retention support while the lockdown is happening and reallocation support once the lockdown is lifted. And as you can see, this package is very effective in lowering the rise in unemployment in the near term and achieving a faster return to the new steady state over the medium term. So let me just close then with kind of an overview of these policy implications from the chapter's analysis and findings. So in general, the recommendations we would take from this would be that countries with fiscal space should maintain support for job retention while the transitory shock from the pandemic is ongoing. This helps to avoid socially costly unemployment spells and dampen the effects, particularly on more disadvantaged worker groups, such as the lower skilled, who we see have been most hurt. Now, as a recovery gets underway, a more vigorous deployment of worker reallocation support can help hasten that labor market adjustment. And then now there's this deep question then about the pivot from retention support to reallocation support. Well, we think based on kind of the model results that could be linked to the duration and intensity of the pandemic. So meaning when the pandemic is really acute, you want to focus on the retention, but as it starts to wane, so that could be because of the vaccine rollout or control measures that are able to kind of get things under control, then you can switch to the more kind of reallocation support. Now, uncertainties about the pandemic and its path mean that the phase out of such measures is probably going to be more complicated than just, this kind of simple rules that I'm kind of describing here. The other thing is that policy support could also be designed to help target more effective workers. And in particular, so as we move into reallocation support, you could think about increasing hiring subsidies, say, for youth or lower skilled workers to encourage them to get reattached to new jobs and basically kind of reduce kind of the burden that they experience from the shock. And I think that's all from me. Thanks. Happy to take questions then.
Great, thank you so much, Melha. And John, we do already have a few questions. If you would like to ask a question, please put it in the question in the Q&A tab on Zoom. But our first question comes from Mala Raghavan from the University of Tasmania. My guess is her question was for Melha, but I'll let either of you answer it. The question was, how does the pandemic affect income inequality or distribution in advanced economies compared to in the pre-COVID era? Melha, would you like to take that one?
Thanks, Renee. John may also want to chime in on this one. I think a couple of things I'll say and then pass it on to John. One is that in terms of the differential impact on the labor market, similar patterns to what we've seen in the EMs and the LICs, and in terms of the low skilled and the workers with lower educational attainment being harder hit. And that would suggest, of course, that income inequality goes up. But we've also seen at the same time substantial support in terms of cash transfers and in some places job retention schemes, wage subsidies that have been provided, which have perhaps taken a bit of the edge off of that process. So it's still too early to say how income inequality in advanced economies will evolve coming out of this, but my sense is that it's probably going to be similar to what we're likely to see in the EMs and LICs, but with differences because of these lifelines that were provided. But perhaps John has more to add to that from the analysis that this chapter has looked at.
Yeah, I think, yeah, so Malhar, I think, yeah, on the income inequalities, gave a good response. But I guess I don't know if the questioner was thinking of this, but of course there's many different dimensions, I guess, of inequality. And so like one is just ability to have a job. And there we've seen very clearly a big difference across different kinds of worker groups within countries. And that's been very broad, as I was kind of just presenting, right? That's in advanced economies. Similarly, we see that same kind of differential effect with the youth and low skilled in particular being hit harder in emerging market and developing economies. Women in particular were hit very hard, harder than men. Particularly early in the COVID-19 shock hit in that second quarter of 2020. That then has kind of abated some in advanced economies, but has actually persisted a bit longer in emerging market and developing economies. So.
Thank you. I should also have introduced our other panelists who are joining us today. Augustus Panton is in the research department at the IMF. He just joined very recently. He's a recent PhD graduate from the ANU, and Warwick McKibben, who is the director for the Centre for Applied Macroeconomic Analysis. I'll now move on to our next question, which is from Larry Liu, who is a researcher at the ANU and in Palmer as well. And the question is to Malhar. One consequence of expansionary monetary policy is that asset prices, particularly housing prices, have been pushed up substantially. Would this be a potential risk given low interest rates are expected to remain for long? For you, Malhar.
Thanks, Larry, for that question. It's obviously always dangerous to speculate about the movement of asset prices, but one difference, I think, or maybe two differences relative to what we saw in the previous run-up in house prices in the US in particular, is one is in terms of the profile of borrowers. We don't see as much of a share of subprime borrowers this time as we did in the previous episode. So that's one area which suggests that the risk is probably the risk of a severe correction and the inability of borrowers to service their loans is probably going to be lower in this episode than what we saw in 2008, 2009. The other aspect is also the type of mortgages that are being originated. A smaller fraction now of these adjustable rate mortgages and the no interest type of mortgages that were being originated 15 years ago. So that's another factor that perhaps suggests that the risk of a severe correction, again generated by interest rate resets that make it harder for borrowers to service their mortgage loans. That type of risk is probably less in this phase that we're in right now than the correction that we saw, or certainly right prior to the big events of 2008. We'd seen the housing market starting to correct in the US from about mid-2006 and the wave of mortgage defaults that began in the spring of 2007. So compared to the 06-07 episode, I think we're seeing differences today in terms of the profile of borrowers and also in terms of types of mortgages that have been originated. Internationally, I mean, this is not just the US, but the run-up in house prices is not just a US phenomenon. It's also something we're seeing in most countries for which we have reliable housing price data. And our sense is that this is a reflection of pandemic-induced demand, the desire to own individual single-family homes, move away from condominiums and shared living spaces in apartment buildings, and this is, this process will likely play out for a while until people feel comfortable about living in urban downtowns again and sharing those communal spaces again. But all in all, as I said at the start, even with the caveat that is always dangerous to speculate about the movement of asset prices and the risks associated with that, my own sense is that there are a number of factors that differentiate this run-up in house prices from what we saw prior to the GFC, which suggests that the risk of a severe correction is probably less this time around.
Great, thank you, Malha. Our next question comes from Sud Dahal, who is a PhD candidate at the ANU. He says, thank you for the presentation. There was a proposal by the IMF chief economist, Geeta Gopinath, to end the COVID-19 pandemic, which calculated the benefits about $9 trillion, far outweighing the costs, which were estimated to be about $50 billion. The proposal targeted vaccinating at least 40% of the population in all countries by the end of 2021, and at least 60% by the first half of 2022. Has that gained traction?
Thank you for that question. So the proposal had essentially, on the vaccine segment of the proposal, there were three main aspects to it, right? First was additional funding for COVAX. The second was donation of excess doses from advanced economies to emerging markets and low-income countries. And the third was the full removal of all export restrictions on raw materials and on finished vaccines. So in terms of the funding for COVAX, there has been some movement. There was the summit earlier this month where donors got together with governments and foundations got together to commit to provide additional funding to COVAX. Which will now allow COVAX to secure doses to distribute across the 91 AMC countries that it is targeting right now, and enable 30% of the population in those countries to be vaccinated. Of course, the big question mark is whether the logistical hurdles and other obstacles can be overcome in terms of actually acquiring these vaccines and distributing them in time to these populations, but at least on the funding aspect of it, that there has been some movement there. So that's one indication, I guess, where things have moved in the direction that the pandemic proposal had called for. In terms of donations, again with the G7 summit, we saw a commitment to donate 870 million doses. That's a start, and that's a movement in the right direction. And in terms of restrictions, the US has rolled back some of the restrictions that were in place under the Defense Procurement Act. There's still, of course, restrictions elsewhere. India, for instance, is not at this point exporting vaccines. There was a big supply to COVAX. So that's one area where we're still waiting to see more progress. But in general, I would say that for the vaccine component of the proposal, there has been some movement in the direction that the pandemic proposal called for, and that could be taken as a sign of that proposal having had some traction, at least with the key stakeholders who are in a position to make the decisions that will help us end this pandemic rapidly.
Thank you, Malha. Our next question is from Dr. Imran. The question is, thank you to all the distinguished guests for the presentations. Given the current circumstances, it can be assumed that the pandemic will further increase inequality and poverty. It is predicted that the number of new poor, especially in developing nations, may rise in the near future. What key policy measures can help these nations to avoid worsening inequality and poverty?
John, do you want me to start, and do you want to, because I want to make sure that you have a chance to say. Do you want to go first? And I'm happy to chime in as well. But
yeah, no, I'm sure. I mean, I think a complication in a kind of like low income. So the advice, at least on the labor market side, that I presented was about this kind of job retention support measures. A complication in with that kind of advice in the context of, say, like low-income countries is that a lot of jobs are informal. So informal employment means it's harder to, there isn't like necessarily a counterpart that you can give a wage subsidy to ensure that that job is supported. So there you have to be a bit creative and adaptive in kind of how you can try to supply that support. And it's through things like cash, targeted to cash transfers, basically. That's one of the key pieces of advice that comes out to kind of protect those informal workers from the big income shock that could be associated with the pandemic-related decline in activity. Of course, that requires that you have some fiscal space in order to be able to fund that, and that's where you know, for economies that do have that, then that's a possibility. For those that don't, that's where then the possibility for some support through international financing could be helpful. I guess I'll leave it at there and turn it over to you, Malhar, for any.
No, I think, John, you covered it very well. I mean, that, as I see, that three aspects to this. I mean, three questions: like what do we do, how do we go about doing it, and how do we finance it? And John, you covered the what do we do in terms of increasing social assistance, social insurance, and how do we finance it? Of course, there's some countries where they might be able to do it through increasing the progressivity of taxation, to close close loopholes, reduce tax expenditures, and to generate the revenue in that way to fund the expanded safety nets that will be needed to combat this problem, and of course the worker training that's needed to facilitate movement of workers into the growing sectors. But there's a third question is in terms of modalities, and one interesting development out of the pandemic is that the use of digital payment systems, electronic transfers, and we've seen a lot of innovation on that front in Africa, for example, in places like Togo, and of course Kenya was already at the forefront of this with mobile money systems, but transfers, relief measures transferred through digital means in places like Togo, and examples of that sort, which are certainly very encouraging, that new modalities are being developed to provide relief in these times. And the same can be applied on the flip side in terms of improving domestic revenue mobilization using e-filing, enhancing compliance through that way. So in all of this gloom that we've had over the past few years, over the past year, there have been some interesting policy innovations that hopefully we can build on going forward and expand in terms of their applications across other countries as well.
Thank you. Warwick, you have a question?
Yeah, thanks, Renee. Yeah, thanks, Malhar and John, for great presentations. I want to come back to this question of inflation that you touched upon, and it seems like you weren't too concerned. I mean, it's a very complex situation because what drives inflation is excess demand relative to supply. And we know that supply has contracted, and we know certainly government demand has expanded dramatically. So if we're not seeing inflation coming from that mechanism, it must be because private demand from investment and consumption must have dried up. You showed some trade numbers. It seems like trade is moving again, so the demand through trade will be expanding. Is there a risk that government won't be able to withdraw fast enough if private savings really does start to fall and we get a big consumption surge? So it seems to me from a goods market perspective, there are some really complex risks there. Is supply really going to expand fast enough to absorb the demand coming out of the crisis? Or are we in a new situation where the production structures have been so disrupted that you're pushing demand without the supply response? The other side of that is the balance sheets of governments, households and firms. And we've seen an enormous amount of debt being pushed into the system. We haven't seen the pricing of that debt respond very much, which means the supply and the demand must have moved together. But again, you can imagine scenarios where the balance sheets of different agents in each country is potentially going to change quite quickly as we come out of this pandemic. And so you've got those two sort of issues to worry about. Just curious on your comments on is this something we can manage, or is this potentially a serious risk?
Well, it is. we would be the first to acknowledge that there's huge uncertainty around the estimates of slack and the output gap, the extent to which demand, the output gap is closed, and how much more slack there is in the system. But where we're coming from essentially is that we see, even with the mismatches the supply-demand mismatches that have emerged in the labor market in certain sectors, for example, hospitality, where there've been worker shortages that a lot of restaurants and other firms are reporting in that sector. Overall, there's still quite a lot of slack. Here I'm talking about from the US perspective. Overall, there's still quite a lot of slack in the labor market. We're still about 8 million jobs below where we were prior to the pandemic. We know that there are people who've had to sit it out because of childcare constraints. They've exited the workforce, and once childcare centers reopen and the economy fully reopens, presumably these workers will re-engage with the workforce, and so there's latent labor supply waiting to come back in. So that's one aspect of it. We see a long exit ramp from this, and a long exit ramp to work off the slack in the labor market. The second aspect is that so far, at least, inflation expectations appear fairly well anchored, and that's been an important part of all of this. That the communications have been key to keeping those expectations anchored. There was, as I mentioned in the presentation earlier in the year, some volatility, some sense that perhaps inflation could get ahead of the Fed's reaction function and may get out of control. But those fears seem to have again faded somewhat. The 10-year Treasury yields have come down over the last 2 months. Break-evens have stabilized. So those fears seem to be abating as well. And the third aspect, the third pillar that our judgment rests on really is that the forces that were at work before the pandemic, automation, for example, which weakened the sensitivity of prices to changes in slack, have, if anything, perhaps intensified through this crisis with the shift towards digitalization. So we expect those forces to continue to be operative coming out of the pandemic, and therefore we think that the overall response of price pressures to diminishing slack will continue to be broadly similar to what it was before the pandemic. Of course, we're going to have temporarily high inflation this year because of the factors that I mentioned, the base effects from commodity prices, the fact that as the economy reopens, we are hitting up against supply constraints and input prices are going up in some sectors. But once these transitory disturbances work their way through prices, we expect inflation to come down again to pre-pandemic ranges. But that's the baseline view. Of course, there are big risks around this. I mean, this is uncharted territory. We haven't seen a recession of this kind before. We haven't seen a recovery of this kind before. And there is a concern that inflation expectations increase if these transitory price increases persist for a while. And as you mentioned, with the buildup of excess savings, as they start being deployed, as they start being drawn down, together with the substantial policy support, especially on the fiscal side, that's already in the system, all of these factors coming together could cause inflation expectations to increase. And that's clearly a risk factor. And if that were to happen, that would, of course, put more pressure on inflation going forward. So really, for me, the key question is how do inflation expectations evolve from this point on, and whether central banks can keep a lid on those inflation expectations through this period of turbulence.
Yeah, thanks. That was very clear. Thanks.
Okay, can you hear me? Because my sound has totally dropped out and I cannot hear anything. So I think that's probably a good time to end this webinar. So thank you, Malhar and John. It was really lovely to see you again and to hear from you again. I know that you can't hear from the audience at home, but audience at home, please join me in thanking Malhar and John for their excellent presentations.
Thank you very much. Thank you.
Yes, thanks a bunch.